Hello everyone. Welcome to the second lecture of our Unit 3 Mutual Fund. So in previous lecture, in first lecture, we have seen, so this is from our first lecture on mutual fund. So in first lecture, we have seen types of mutual funds, then the advantages of mutual funds, what do we mean by net asset value, and the definition of mutual fund. So this was all about uh, first lecture. So let me close this window. Okay, so here I am with the second lecture. Just wait. Okay, so let's begin our second lecture on mutual fund. So in this lecture, we have few more types of mutual fund. So these are types of equity mutual funds. So one is small cap mutual fund. So what do we mean by a small cap mutual fund? So small cap equity funds invest in smallest companies in India. These companies are beyond the top 250 companies and are mostly unheard in our daily lives. That's why they are called small cap mutual funds. So while they give fantastic returns, small cap companies are highly volatile and you can see losses in short or medium term. Okay, short or medium term. So they can give a handsome return, but at the same time they are highly volatile. You can see, or you may face loss in small uh, small cap mutual funds. So some examples of uh, small cap. In fact, all type of all the banks, all companies, they have small cap mutual funds. So Quant small cap fund, Tata small cap. So you can see that Tata company is they are having mid cap and large cap mutual funds also. So all the private institutes or the banks, they have all type of mutual funds available. So Sundaram small cap fund, Franklin, though they are very famous companies, but they invest in small cap mutual funds also. So mid cap mutual funds. So mid cap mutual funds are equity funds that invest in mid sized companies of India. These companies are some of the fastest growing companies in India. For example, examples of mutual funds investing in mid sized companies are Axis Mid Cap Fund, Invesco India Mid Cap Fund, etc. Then third type is large cap. So these equity funds select stocks for investment from the largest 100 stocks listed in the Indian market. Large cap mutual funds are expected to be less risky and suitable for investors who are looking to invest for at least 3 to 4 years and looking for high returns. Top large cap mutual funds are Canara Robeco Blue Chip Equity Fund. These are the examples. Mahindra, all are very famous companies. Now let's move further. We have, what do we mean by direct plan and regular plan? So we have seen in previous lecture that what few mutual funds, they had written direct plan in the end and regular plan. So in this lecture we will clear with this. So here I have some examples, some pictures. So you can see that Axis Blue Chip Fund direct plan growth, Parag Parikh long term direct growth. So this is direct growth. So these are the list of mutual funds in which you are investing directly in these mutual funds. So that's why it's written direct plan growth. Whereas here, so let me zoom in so it will be visible very clearly. Okay. So Mirai Asset Large Cap, regular. This is a regular, again regular, again regular. So this means that there is one agent in between you and the investment, uh, the mutual funds, who is helping you to invest in these mutual funds. So it's a regular thing. You are taking help in mutual fund investment. It's a regular investment. Now let's move further. We have direct plan and regular plan. So to buy directly from the mutual fund, so what do you mean by direct plan? You buy directly from the mutual fund company, usually from their own websites. Whereas in regular plan, you buy through an advisor, broker, or distributor. Second point, in direct plan, here the expense ratio is zero. So there is no expense ratio you are paying to anyone. So you don't pay commission to any broker. You have to pay expense ratio. Usually mutual funds company cuts commission from your profit to pay the broker. Third point, you must have knowledge of investment in mutual fund. Obviously, you are doing everything by yourself, so you must have all the knowledge. This thing, the regular plan suits to the investors who do not have knowledge of mutual fund or share market. Since the four points, since you are not giving any commission to the advisor or the broker in between, so profit is more, maybe 1 to 2% is the expense ratio. It could be less than 1% also. Profit is less as compared to direct plan because you are paying some uh, charges to that advisor. So let's read this. The question is, what is expense ratio, what is entry load, and what is exit load? Excuse me. Okay, so expense ratio is the annual maintenance charge levied by mutual funds to manage its expenses. It includes annual operating cost, management fees, allocation charges, advertising cost, etc. of the funds. So there is some expense ratio you have to pay to the person in between or the mutual fund company. So value of expense ratio depends upon the size of the mutual fund. Expense ratio have an inverse relationship between the fund size. So expense ratio, total operating expense, this is the formula to calculate expense ratio. Total operating expense divided by average value of fund size. So this formula measures how efficiently a fund is managed. A higher ratio indicates that more expenses are incurred to manage a set of amount of fund, whereas a lower ratio indicates that less expense is needed to measure the same amount of asset. That is, management is more efficient in operating funds. Mutual fund companies collect an amount from investors when they join or leave a scheme. This fees is called load. Entry load is the amount or fees charged from an investor while entering a scheme or joining the company as an investor. Exit load is a fee or an amount charged from an investor for exiting or leaving a scheme or the company as an investor. So here's a note: Securities and Exchange Board of India, that is SEBI, has implemented a no entry load rule on mutual funds. So now there is no entry load. So you can invest money with 0% of entry load. So no money is charged on investing your money. So here I have some myths about mutual funds. So there are a few myths and misconceptions associated with investing in mutual funds. Some of these have faded over time as investor awareness has increased, but some continue to hold strong. First myth is lower net asset value is, so lower the NAV, it is cheaper. The most common myth among mutual fund investor is that investing in mutual fund with lower NAV is better buy than mutual fund with higher NAV. Here's the explanation how. Suppose that I am investing in a mutual fund whose present NAV is rupees 10. So one unit will cost me rupees 10, and I have decided that I am investing 10,000 rupees. So with price of one unit rupees 10, and I'm investing 10,000, how much unit will be allotted? 1,000 units will be allotted. Now suppose I want to sell after some time. I want to sell these 1,000 units, and while selling I have noticed that the price of one unit has increased by 1 rupee. So the new net asset value is 11 rupees. So what is the amount received? So while selling the this 1,000 units at this cost of one unit, I will receive 11,000. So 11,000, this gives me 10% of rate of interest. We will see how to calculate rate of interest. So this is just an illustration. Keep these figures in your mind, and let's come on to the second mutual fund whose net asset value is 200. You can see that the net asset value here is rupees 10, which is very less. We cannot compare this with 200. 200 is very large value than 10. And again I have decided that I have to invest same amount, 10,000. So number of units allotted will be 50 units. So 1,000 units in previous mutual fund and 50 units in second mutual fund. Again I have decided to sell these 50 units. While selling, I came to know that the net asset value has increased to 220 rupees. So how much money? Again I am going to receive the same, but the rate of interest is 10%. So the same amount in the end, same amount invested, but the net asset value is different. So you can see, you can compare these two mutual funds, and this is the myth that the investing in the mutual fund whose net asset value is very low will be beneficial is a myth, because they both are giving same same rate of return, same amount after some time after selling. Okay, now let's come to the second myth. Demat account is required for the mutual fund investment. Except in cases of schemes or the mutual funds which are listed on stock exchange or the share market, demat account is not required. Third myth, high fees and expenses. Entry load is 0. It's declared by SEBI. Exit load, it vary from 1% to 10%. Some mutual funds, they may charge 0.8%, less than 1% also, and other recurring expenses, they are very nominal. Fourth myth, there is brokerage and transaction cost. Yes, there is some brokerage, but it's already included in this. It is included in exit load and recurring expenses. No other cost is taken from the investor. Now, So here we are with numericals on mutual funds. What are the ways to invest in mutual funds? This is theoretical question. Maybe after two questions we have numericals. Yes. So these two are some theoretical and definition based questions in numerical sessions. So what are the different ways to invest in mutual funds? Here are the different ways of investing in mutual funds. First is through agent, second through asset management company AMC, through AMFI website, Association of Mutual Funds in India. So they have their own websites also. Through DMATS account if it is related to some share or stocks. Web portals also. These are the examples of some web portals: Funds India, Fund Supermart, and the last is banks. The bank, they have their own mutual funds investing in different sectors. Next question: explain how investment is done in SIP, SWP, and STP. Let's see what do you mean by SIP, SWP, and STP. Systematic investment plan, SIP. SIP is an option of investing a fixed amount in a mutual fund scheme on regular or fixed time interval. The amount can be invested manually every month or on fixed date, or it is deducted automatically from the linked bank account. It is a disciplined investment plan, and one can build significant wealth in long run with small investment of money. Now, SWP, Systematic Withdrawal Plan. Systemat SWP is a smart way to plan for your future needs by withdrawing amount systematically from your existing portfolio, either to reinvest in other portfolio or to meet your expenses. It helps investors who require liquidity, as it allows them to access their money precisely when they need it. What is STP? Systematic Transfer Plan. STP is a plan that allows the investor to give a mandate to the fund to periodically and systematically transfer a certain amount or number of units. This is important. Either you can transfer money or units from one scheme and invest in another scheme. It helps ensure that your money is unaffected by market volatility in short term. Okay, so here's the numerical. So first numerical is a person invest 10,000 in a mutual fund with entry load 2%. Okay, so this is just an example. So this 2%, they are taking 2%. Otherwise, in practical life, it is 0. So entry load is 2% and exit load is 1% before 2 years. If you exit that mutual fund after 2 years, there is no exit load, and nil after 3 years. Okay, so after 3 years, there is no exit load. He receives dividend of rupees 1,000, 1,100, 1,200 for consecutive 3 years in cumulative dividend scheme. What is his total rate of return? So how to calculate rate of return, we will see in this part. Second, and what is his annualized rate of return if he redeems all his units after 3 years? So after three years, he is not giving any exit load. So let's come to the solution to this numerical. Amount wanted to invest in mutual fund is 10,000 rupees, but there is 2% entry load, so that person needs to pay 2% extra, or it will be deducted from this 10,000 as entry load. So entry load is 2% of 10,000. It comes to rupees 200. So he is going to pay 200 rupees extra, or that 200 rupees will be deducted from this 10,000. So his total investment, if in case 200 is deducted from this, his total investment will be 9,800 rupees. But in this example, I have taken to invest 10,000, he has to pay 10,200. So from his pocket, he is giving extra 200. So when he pays this much amount, his portfolio will show that he has invested only 10,000 rupees, but his pocket is being charged with this much amount, 200 rupees extra. Given that he receives dividend for consecutive 3 years, that is 1000 rupees for first year, 1100 for second year, 1200 for second year. So after 3 years, he sells all the units. While selling, he doesn't pays in any extra money, that is extra exit load. So after three years, there is no exit load. Now, money received after selling is, so this 10,000 he will receive this 1000 rupees as his profit, that is dividend for first year, dividend for second year, dividend for third year, total 13,300 rupees. Okay, so how much interest, how much profit he had done? Interest received, profit money received. So how much money he has invested? 10,200. How much he got after selling? 13,300. Okay, so this 10,200, this is the total money gone from his pocket. So that's why I have taken this amount, not 10,000, though his investment is 10,000. So the profit amount is this much. Now, how to calculate rate of return? So, this is the formula for rate of return: interest amount and the total amount invested into 100. So interest amount is 3,100, and how much he had invested from his pocket is 10,200. Just do this calculation, you will get this percentage. 30.39 percentage is the rate of return. This is the rate of return for 3 years. Okay, now since second B part, since he redeems or sells all the units after 3 years, there is no exit load. So rate of return for 3 years is this. So what will be the rate of return for 1 year? Just divide this rate of return for 3 year by 3. So rate of return for 1 year is just divided by 3. So 10.13%. So this is the answer for first numerical. So here we have, so let me close my webcam window. Okay. So the second numerical, Suresh invested rupees 2,50,000 in a mutual fund scheme with entry load 1%, exit load 2% for 3 years. He had to redeem all the units after 2 years, when net asset value had dropped to 2,30,000. And meanwhile, he had received a dividend of rupees 15,000. What is his gain or loss percent? So this is the total net asset value of his investment in the beginning, and after 2 years, the net asset value of all the units, or you can say that the total value of his what units, total value of his units is dropped to 2,30,000 from 2,50,000. So let's come to the solution. Suresh invested amount in mutual fund is 2,50,000. So while investing, there's an entry load of 1% of 2,50,000. So that is, so you have to calculate like this. So the 1% entry load is is 2500. So total money invested, so 2,50,000 plus more money as entry load. So 2,50,000, sorry, 2,52,500 rupees is the total investment. So after 2 years, Suresh redeemed all the units of mutual fund. Total net asset value of all the units after 2 year has dropped to 2,30,000. This is the amount he will receive after selling, but there is exit load while selling. So what is the exit load? It is 2% of current net asset value. So 2% of the current net asset value is 2,30,000. So 2% of it is 4,600. So that will be deducted from the current net asset value. So amount Suresh will receive after redeeming all the units is this minus the exit load. So this is the exit load he needs to pay on all the on the net asset value of all the unit. The current net asset value is this, so subtract it from it. Sorry, so he will receive 2,25,400 rupees. Okay, here's a good news. He had received dividend of 15,000 also. So total money in Suresh pocket is this plus 15,000, 2,40,400. Okay, so how much he had invested? He had invested 2,52,500. Yes. So he had invested this much amount, 2,52,500, while after selling, he received how much? 2,40,200. Obviously, there's a loss. So loss faced by Suresh, total money invested minus money in his pocket. So invested is this much, received is this much, loss 12,100 rupees. How to convert this loss into percentage? Loss amount, total amount invested into 100. So his loss is 4.79%. So that's all for this session. So let's stop here. Thank you.